Warren Buffett just made a chilling prediction on the U.S. real estate market. Is your real estate investment safe? Could this ominous prediction redefine the fate of your property? In this video, you'll learn exactly what is behind Buffett's alarming prediction, why investors are taking a step back, and if your real estate investment is at risk. And watch to the end to discover the 5 golden rules inspired by Buffett that you can use for real estate investments. Don't forget to like and subscribe Why Trend Money before proceeding. So, did Buffett just drop a bombshell on the real estate market? Well, Warren Buffett, the renowned CEO of Berkshire Hathaway and a veteran in value investing, is sounding a colossal alarm bell, predicting a $1.4 trillion debt-driven storm ready to hit the U.S. real estate market. And this isn't just about rain and thunder. It's a financial storm with potential repercussions, akin to a spreading wildfire. What's behind Warren Buffett's real estate tsunami warning? Imagine a dark cloud forming on the horizon. That's the visual Warren Buffett paints when he talks about the impending storm in the real estate market. The storm is, in fact, a massive debt-fueled tsunami with the potential to devastate on an unprecedented scale. To understand why Buffett is raising the alarm, we need to look at the role of interest rates. Interest rates play a pivotal role in real estate profitability. As these rates climb, those who secured loans at lower rates struggle to keep up with mortgages, plunging into financial trouble. It's like trying to swim against a strong current, exhausting and seemingly futile. The perfect storm is brewing as non-recourse loans mature and funded properties depreciate below their initial purchase prices. The UBS Global Real Estate Bubble Index for 2023 highlights a significant shift in the real estate landscape. Average house prices have fallen 5% in major cities from mid-2022 to mid-2023. The rise in financing costs, with mortgage rates tripling since 2021, has put a dent in house price growth. When adjusted for inflation, prices are now 5% lower than in mid-2022. Cities like Frankfurt and Toronto, once high on risk scores, have seen actual prices tumble by a staggering 15% in the last 4 quarters. While inflation has driven down imbalances due to declining house prices, it hasn't necessarily made housing more affordable. The repercussions of this storm won't be confined to the real estate industry alone. Its reach will extend far and wide, affecting regional and community banks, small businesses, and the broader economy. Why are real estate investors hitting the brakes? Recent data indicates investors are taking a step back, purchasing 45% fewer homes than the previous year. This decline surpasses the overall drop in home sales, marking the most substantial decrease since 2008. The market share for investors has dipped to 16%, a notable drop from its all-time high of 20% in Q1 of 2022. Cities like Phoenix and Las Vegas, which experienced a boom in real estate during the pandemic, are now witnessing significant declines in investor activity. The frenzy triggered by the pandemic, leading to a surge in home buying and rental demand, is subsiding, making investing in homes less appealing. Interestingly, offers from hedge funds have noticeably diminished, shifting the market from being investor-dominated to more accessible for local buyers. In terms of monetary value, the reduction in investor purchases is substantial, accounting for $36.4 billion worth of homes bought in the second quarter, reflecting a 42% decrease from the previous year. But who will bear the brunt of this storm? Contrary to expectations, it won't be the big banks or large investors. Instead, it will hit the individuals and organizations involved in real estate operations and lending who face the repercussions of lending at low rates. They will be left with personal guarantees and on the brink of financial insolvency. The rising prices for residential real estate over the past few years, coupled with stagnant incomes, mean that housing is becoming less affordable for the average person. When demand falls and prices continue to rise, a dangerous bubble is ready to burst, impacting everyone in the market. Is your property at risk in the real estate storm? Imagine you bought a property for $1 million, put down 20%, and borrowed the rest when interest rates were low. It seemed like smooth sailing, but as rates climbed, the debt service coverage ratio, DSCR, fell out of equilibrium. Commercial real estate loans are on the verge of resetting at considerably higher interest rates. If the interest rate on a loan surged from 5% to 7.5%, the property might no longer generate sufficient income to cover the debt, making it financially unviable. And it's not just about rates. The trend of working from home, accelerated by digitization, is hitting the demand for office spaces. Less demand means falling rent prices, adding to the fury of the storm. While this might not be the best time for property owners to sell, holding onto your property could be a better financial decision in the long run. What can Warren Buffett teach us about real estate? Warren Buffett understands the critical difference between buying and investing in real estate. His commitment to a strategy that works is a testament to his unparalleled success. In the whirlwind of new investment techniques and algorithms, Buffett stays committed to simplicity and substance, brushing off market noise that often leads others to panic. So what can we learn from Buffett's warning about the real estate market? Firstly, always be aware of market conditions and thoroughly research before making significant investment decisions. Understand how your decisions could impact your financial future and make intelligent choices for the long run. Buffett's investment philosophies, primarily designed for equity, can be adapted to any asset class, including real estate. Here are 5 golden rules inspired by Buffett that you can use for real estate investments. 1. Be cautious with your money. Treat your investments seriously and do thorough research. 2. Be a long-term investor. Real estate is a marathon, not a sprint. Think long-term gains. 3. Buy from credible and stable builders. Trustworthy builders can greatly impact the success of your investment. 4. It's better to buy a wonderful property at a fair price than a fair property at a wonderful price. Prioritize quality over a bargain deal. 5. Take advantage of market conditions. Seize opportunities, negotiate, and always do your research. Are you following Warren Buffett's advice in your real estate ventures, or do you have a different strategy? Let us know in the comments. If you enjoyed this episode, subscribe and watch our other videos.